Hey everybody, today's video is absolutely packed. There's a lot of theory in today's video and there's a lot of application on understanding how you should be choosing what you're looking at and what is absolute garbage. So I want to jump right into it because there's parts of this video that you're going to want to watch again, and that would mean that I'm going to try to keep this one a little bit shorter. So let's get to this. First and foremost, if we just look at the SPX, we could all see the bearish engulfing right here, and then we can all see how we just kind of had the inside bar. We're not over it yet, but the SPX in and of itself did not confirm to the downside on the move. Very different than what we had from the gap down. If you are somebody that is a trader, you're obviously very happy. Personally, I wanted a flush to get it out of our system. To me, this means I could come up here, start rolling again, and undercut this eventually, and the structure could change. I'm in the camp that I don't know if we're going to break out and take out new highs, and no one ever knows, or if we're going to roll over and go sideways. I think that you need to be prepared for both eventualities. In other words, understanding, are we going to go sideways, or are we going to break out again? I don't have an answer to that. I would say that you have drivers that could do both. I don't see the way that we're going to completely collapse here when we start talking about valuations and growth drivers, which we're going to do in this video. But I do see a lot of pockets of froth and everything in some of the value names that people love to everything in the crypto space. And I do see some value in the crypto space as well as I do in the value space as well. And I want to talk today about how we're going to differentiate that so that you guys can learn to do it for yourself. But if we just do the basics and we look here for a second, we can all see the breakout of the Qs. We get it. You've reversed. You had this bar, you came down, you reversed. Is that really it? On the Qs, I think there's certain pockets that make sense. For example, if you look at the SOX, you're holding in here and you didn't break. If you take a look at the heavily laden SMH, you're obviously holding in here because obviously this is way more NASDAQ based and it's also much more NVIDIA based. It's like 2x NVIDIA than the SOX is. If you take a look at this, yep, you have your little doji, but you really didn't break out. I will say that you are seeing consistent buying in NVIDIA. Consistent buying in the video on the dips. It's not a little bit, it is consistent since it broke out. You've had one retest of that area. So if we go and take a look at this, for example, we can see the rally and the pullback, and then you can't break the 12 and close below it. It's a 12, a 22, and a 55, and you keep pushing. Then you get into the fact of, you have Apple, which is now, you have the two largest names out there that are getting ready to rock and roll. And we're going to go into Apple in detail today. I think that you have to look at that and then look at the other drivers that came out there as well, where you're starting to see the semi-cap names move. And we're going to get into why that's going to happen. Super important, but how are institutions positioning themselves? And then you go and take a look at like the 10-year. And to me, I think that this is really significant. You're not really falling down like they're going to cut rates forever. You had one day where they said, oh, we were going to go from 440 down, and then we kind of hung out in this area. So that's not really doing anything. You look at the dollar, and the dollar looked like it was going to rally, and then now the dollar's kind of washed out again, isn't it? So what we have, in my opinion, is a bifurcating market. And what I mean by that is you have these huge areas that are completely frothy, in my opinion. And then you have these huge areas that are hugely discounted, in my opinion. And this doesn't happen very often. Usually you get an area where there's some are discounted more than others, but it doesn't happen to this extent. And I think that people that have capital are starting to realize this. And I'll show you a couple signs of it. And I just want to go through this very, very quickly before we jump in. If we just take a look at the breadth of the market, you're holding in here. You're in the 50s. You're going sideways. You're not really extreme anymore. You had some really extreme moves in here in both, but you're somewhat flatlining with a curvature to the upside. I mean, you can see the 5, this is the 5, the 20, the 50, and the 200. But you're sort of flatlining here. And so I'm starting to have this theory that of a period of consolidation versus just rampant breaking out as we wait and see what the Fed's going to do. And I do think that people, despite everything, and me talking about this bifurcated market, I do think that they are positioning themselves a little defensively. So for example, if we take a look at the XLP, I think that if you look at that, it's telling you something. So if I go and take a look at the XLP and I just drop the close right there, look at this area and what we did this week while the market went higher. So they're out there buying these names, and you'd look at like PG and you'd say, well, what's wrong with him? Why is he looking at these names? Yeah, I get it that they don't look fantastic. But if you go and take a look at some of the other more favorable names that people like to trade, like the Walmarts of the world, and you think about Walmart from the standpoint of a defensive name that people historically are going to use, you're breaking out here out of a base. So Walmart, like these kinds of names are telling you people are getting defensive. If you look at something like a Costco, I've been watching this for some time and, hoping that I was going to get some kind of pullback here. I hate buying these kinds of trades because there's a DTL up here. But you are getting net buyers and you've had them since Monday. And of course, you're getting that with Walmart too. You're getting those, net buyers in the market after basing for a period of time. Also, if you get defensive and you look at like the SIN names, they're breaking out. Here's earnings, obviously, but more so than that, you're breaking out because people are putting a lot of money into these names. They are buying the SIN names, and I think they're doing it not only because, we're pulled back, we're going to overvalue. I think they're looking at it from a bifurcation standpoint. I think that a lot of people are realizing that there's certain pockets that are out of whack. I mean, look how fast IGV came down. Look how fast IGV collapsed. And these names like Crowd collapsed. I mean, they just absolutely collapsed because FTNT said, market's uncertain, we're not going to give you any kind of guidance. They could not get out of these high flying names fast enough. Look at Snow. All of them is just absolutely get me out now. That's not a healthy market. That's a market that's saying this space might be overvalued and I got to get out. But there's pockets of froth and there's pockets of value. I don't know that this makes sense with the software names. I'm not bashing the software names, but what I'm saying to you is that's how sensitive the market is right now. Now, from our standpoint on IGV, we definitely don't want to break the 55. But you cannot argue with what's going on out there. You look at CRM, for example, and how this has just been falling off a cliff. And now we're going to go into some earnings here, and it's going to be pretty interesting to see what happens. These were names that people had to be in. You're looking at Net, which crushed. They can't get out fast enough. And I think that that's really very important where I want you to understand this. Whereas you have these other pockets that people are just absolutely rushing into. So what does this mean? Well, it means that people start parking capital in different places, like these look at these dividend names, like all the SIN names. BTI's breaking out, right? At MO, PM, we bought this in the community, like for whatever reason that people sold it. It presented a huge opportunity. I think I'm up $7 or $8 in this thing. So where I'm going with this is pockets of froth, pockets of value, understanding how you're going to learn what the differences are, and then how you can learn to do this for yourself. And I'm not saying that there's also not like really great trading vehicles right now, specifically the names that people are short the most in. You need to be looking at those names, but let's get into it. Now, is there froth in this market? Yes, there is. And I'm going to show you a really neat trick here. If you take a look at BMNR, for example, you have a $6 billion market cap and $3 billion is in Ethereum. Out of that, you can see the movement that you're having here because everybody gets excited when they say they're going to buy more of it. The bottom line with this is it's just going to be constant dilution where they are selling shares and buying more ETH, selling shares, buying more ETH. What does this really do? Well, one, it makes your position completely dilutive. But should this trade at a level so that you could say, yeah, I have a stake in this? My concern with these are, I don't think people truly understand the structure. For number one, they'll compare it to MSTR. MSTR has a business, it's a legacy business. And the reason that they even got into the business and of buying Bitcoin is because deterioration of the dollar. That's the sole purpose of why they got into it. They have this business. The business was great. It makes them money. It's a legacy business. Every year they're making, or every quarter they're making 125 million. And they have some earnings. Okay, great. Fast forward, they realize the deterioration of the dollar, and he starts this Bitcoin spree, and now they're the biggest out there. But they can service their debt. So then the question becomes, when you look at something like a BMNR that has no business whatsoever, their business is to go out there, issue shares, and buy ETH. There's no moat to this business. Literally no moat. Literally anybody can do what they're doing. Yet for some reason, people are going to pay a 2x premium to buy ETH themselves. Here, just real quick, I'm just going to give you a cheat code. You can go and buy it yourself. Just go on any one of the brokerage sites and just go and buy it. I mean, over time, what's going to happen here is that this is going to trade at a less of an NAV than it is in regards to this. There's no way this is going to stay at 2 or 3 times what the underlying asset is worth. It's just not going to happen. Now, it could be like the early days with MSTR where people are trying to figure it out, but this organization cannot issue convertibles. Could they stake the ETH and get a dividend and do it that way? Maybe. But then how are they paying all the people that work at the company? How are they paying all the salaries? It becomes a thing. And I don't think people are truly getting this yet. So I actually am thinking that these are very close to what we saw before with crypto, people trying to figure out a way to get involved. And what do? We came out with NFTs. This is not going to be as bad, but this is going to be pretty bloody when it ends. I think they're all going to trade very similar to that NAV or very close to the NAV, but no one can give me a really good reason what the difference is between a, quote, treasury and an ETF, except the fact that the treasury can go out there and just issue infinite shares and just keep buying this over and over again. Eventually, the really weird thing about this is someone's going to run into a liquidity crisis. At one point, they will, for something, for one reason or another, and they will have to sell some of that, and it will begin to spiral on it. It is the way this stuff always goes. I've seen it year after year after year. The other thing I would say is you're getting discrepancies amongst these treasuries. So if you take a look at something like an SBET, this one is 2.3, and it has 2 billion of ETH in it. Now, what's so fascinating to me about this is that when I look at something like this one actually made sense when you looked at it, on the first, because you were actually trading almost at a discount to what they wound up owning. Now, I know that they issued more shares in here, but when you know that they're going to issue shares and you're trading near the NAV, that's when you want to look at these things. So if you're like, you don't get it, boomer, cool, I don't get it. It won't be the first time. I didn't get NFTs either. I think there's obviously a difference here because I do think there's value with crypto, obviously, because I do own it. But if you look at something like this, understanding that when they issue a secondary and everybody is selling them, or when they're doing these value, they're going out there and selling stocks so that they can go out there and buy, that's when you should be looking at them. But I think there's a huge discrepancy here where this one's trading at a huge discount to what this one's trading at. So if you overlay these names together and you put them in a graph, I go to July 1st because that's when this one decided it was going to be something. You'll remember Tom Lee came out, everyone said just going to $1 billion, right? All right. And then obviously they were on, TV on Friday talking about this is the cat's pajamas. I should have a disclosure. I am short this. Just FYI, just so you understand where my head is. I didn't short this. I did not short SBET because when I look at something like this, I'm like, all right, well, I'm 11% off. All I need is a bad day. I need a bad day on this in regards to the underlying asset. And this is something that you could buy. And then as the premium goes up, you might sell them as the premium gets over. I do think that you can trade something like this. But there is froth in this market. There's no doubt about it. And there's froth throughout the entire market. People looking for the next one. Like, for example, you're seeing it with Tron comes out, and then Tron's going to be one. Okay, because why? Because of Tether. All right, great. And then you're going to have the Solana one. If you really believe in this stuff, just go and buy the actual crypto. I mean, this thing's actually breaking out. Like, ETH is actually breaking out of a multi-year base. And you can see your undercut right down here, your flag, your retest of that entire flag, the inside bar, the doji, and the breakout. And since then, you've been ripping. And it makes sense. Like, it does make sense to look at these if you believe in stablecoins, which I do believe in stablecoins. I think it's going to be one of the biggest things over the next couple of years. But that doesn't mean I have to run into Circle right now, right? It's what, who, when. Whenever we look at the market, we always look at the market that way. When we look at the stool, we always have to remember you have your macro side of the stool, you have your fundamental side of the stool, and then you have your technical side of the stool. And so when you have like macro changes, you always have to go, well, who's affected by those macro changes? Excuse the voice, it's rough this morning. But if we look at this, right? All right, so there's a macro event that's happening, stable coins. Everybody understands it to an extent, but it's going to be absolutely huge. It's going to be probably the biggest financial engineering that we're going to have seen in our lifetimes. I think it is. And there's reasons for that because it makes sense, it's more efficient, and companies get to keep more profits, and consumers are going to get to keep more profits in their pocket. And then you're going to like, okay, well, that's what's going to happen. Who's affected by that? All right, so these guys are affected by it. And then they're going to use Ethereum, Solana, and I'm not just talking about these guys. I'm not talking just about Circle, who are the issuers, right? Whether they're going to use Ethereum, Solana, Tether, it doesn't matter who they use or what the underlying part is. What matters is that this is going to be here. So I have the what, I have the who's, and now I just need the whens. So when I look at something like this, well, this is not when to buy this because I've broken the IPO VWAP. If we just did the simplest things and lay over our moving averages, we wouldn't go near this if it was something else. So when is not now, because we don't know where these things are going to land or what the true valuation of them are. And that's how you need to look at this stuff. But it doesn't mean it's not now. So you have to watch it technically, right? Hopefully you can understand the difference in that. So if I look at something like a BMNR, people are like, oh, well, it's breaking out. Yeah, they're just going to wind up selling more shares when it's trading at a premium. I would actually argue that as long as this thing's trading at like 2x or something like that, every time you know that they're trading at 2x, they're probably going to come out and do another secondary. So I would expect them to come out and do another one. Well, why wouldn't you? The street's giving you free money. You're selling worthless shares to go and buy something that has worth. So of course they're going to do that model. It just makes perfect sense. Why wouldn't you do that? What I look at is trying to figure out where these NAVs are and these book values are, because there's all these little side deals with people having shares, etc. And I look at something like SBET versus BMR, and this is when it first came out. And you can see that obviously the difference in here in the moves. And we'll go back and look at SBET, and you can see how this one rallied and then it fell apart, whatever. But from when July SBET comes out, and then BMNR comes out, and then you can see the drop in the dip. I just think this little area is very interesting right here. I'm just going to point it out to you because I think there's a trade here. And I know people will look at this and go, well, that doesn't look like there's a lot there. This doesn't look like there's a lot of money. Long SBET, short BMNR. And what I would say to you is like when these things turn, and you don't know, you watch these kinds of things, but when these things turn, if you look at this move, and let's just say you caught that breakout, when you saw the breakout of that, well, that issued a 230% return in about about a week. So there are times when these two things are going to come closer together. I think the trades are pair trades. I really do. I think that it's actually going out there and even buying Ethereum and actually shorting BMNR. Chanos does something very similar where he owns Bitcoin and shorts MSTR when it gets over a certain level. So what he'll do is he'll go out there and take a look at MSTR and he'll say, okay, well, you're trading at 1.6 or 1.7. I think, I forget what his level is, but it's something like that, where anytime it's over like 1.5, he's like, all right, well, I'll short it and go long Bitcoin, and then I'll just wait for the spreads to tighten. The spreads always tighten. They always find a reason to. And if you can look at it and see that. So if you go and take a look at something like a BTC, USDT, and this was supposed to be a basic video, and then now it's not. But if you take a look at something like this, you'll always see that, oh, this is trading up. But look at the difference. You can see that even with Bitcoin rallying and hitting new highs, you'll hit periods where MSTR will stay under. And that's because the NAV of MSTR's position in Bitcoin is losing that premium. So you're shorting MSTR versus going long Bitcoin. So if we take a look here, I'll do it this way. Long Bitcoin, short MSTR. Here's your highs. And we're going to go back 12 months because these, you really don't want to go all the way back because it throws the whole thing off because of where MSTR was, the froth, everything. But now that it's more mainstream, the trade's a lot easier. If you look when you're up here, obviously, this is an area where you'd be like, oh, well, clearly, blah, 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 you were better off, owning Bitcoin versus MSTR down here, and here you weren't. The bottom line is you want to do the trades when you're down here, right? So you're trading, it's a pair trade. So you want to do it when the valuations are setting at the low end of the market, not when they're at the high end of the market, right? So you want to set the pair trade when you're at some kind of support level. And again, you can see these levels up here. But so what I'm suggesting is that if you see something like SBET and you divide that by BMNR, and you're going to see it all out of whack here. But if we go and take a look at this sucker, and let's do it on a 15 again, and we're looking at something like this, and you're like, okay, well, this is a support level where the parity trade was. I think it's worth paying attention to this level. The other thing that you could do is if you're like, I don't want to do your pair trades, Boomer, you could just look at this and go, all right, well, if I wanted to get involved in this, which one do I take a look at? Well, you'd have to look at SBET versus looking at BMNR. But my point here is that this is frothy. This reminds me a little bit of the NFT space where we're going to take pictures of tweets and sell them for millions of dollars. I just think that you need to understand that. And it's not just crypto where you're seeing froth. Now, if you look at Berkshire Hathaway, for example, you can see that the price to book ratio will go anywhere between trading at book value to being a max level, which was the great financial crisis, I believe, to currently you're at 152. And I would argue that it's worse now because of the concentration, because the concentration is 70% of Berkshire Hathaway is in 5 names. So when we look at Berkshire Hathaway, let me just see right here, here's your trend line and you're cracking up here and you're trading at 50% over the net asset value. So let me just kind of wrap your noodle around this and what's happening. According to their latest filings, these are their stocks. This is what they own. So they own Apple, 25%, American Express, Coca-Cola, Bank of America, Chevron. So when you look at something like this is Apple divided by Berkshire Hathaway. And you're just going to take a look at relative performance, but you're really also going to see a pair trade here. Now, we're going to drop these in a couple different spots so you can see where I'm going with this. When these valuations get to support levels, that means they're extreme. And obviously you have the huge breakout of Apple, which of course during the pandemic, and of course a value name is not going to keep up with that. But when you see this, it's real clear what you're doing. you're buying Apple down at these support levels and you would short Berkshire against it, right? And people say, well, there's not really any money made doing this, all right? And so you go take a look at like April 10th to where the peak is, and that would be 70%. If you take a look to where we historically hit the multi-year peak, it's roughly 55%. And you're long Apple and short Berkshire. It's such a low volatility idea, it's crazy. But these valuations, these NAVs, they're going to contract. And that's the important thing about that. They will contract over time, and that's when they get here, and then they'll expand because something will happen. Tim Cook will show up with like a poster board at the White House, et cetera, et cetera. I think it's really important to get this because then it will tell you like, hey, some of this stuff, it is a little frothy. And I don't think it's just, I want to be real clear, I don't think it's just in crypto. I think there's some things out of here that are really out of whack. Like, why would I pay 50% more to own Apple through Berkshire than going out there and buying it myself? There's 70% of those names. Now, you could say his management style is unprecedented and his ability to navigate and access to the capital markets is something that I don't have. And you would be 100% right. You will never have that, right? What do you do about that? Okay, you assign a premium to it. Is it 10%? Is it 20%? I would argue that, yeah, you should be paying a 10% premium or 20% premium for him to manage your money. That makes total sense to me. That doesn't give you this extra 30% that's hanging in here. So when you look at something like this and go, okay, well, where should I be looking at this? And you think about 30% coming off this name and what it would look like. And it puts you down here around 340, 350. I think that's very realistic for something like this to happen. And I think where I'm going with this and what I want people to get is that, yes, number one, there is froth in this market. And it is on both sides of the market. It is in the value names and it is in the crypto names. And where I think that we're going to have to go through is you're going to have to start looking at the who. And people are going to be like, what's he talking about now? So the who is going to be the fundamentals of stocks, right? You have the what is going on, and then you're going to have to look at the who, and then you have the when. So I really think people are going to have to start doing homework again, which is going to be really hard for people since they're used to somebody tweeting from their basement, eating a Hot Pocket to make their financial decisions. But you're going to have to start looking at the fundamentals on what's going on with these companies and what's going on out there, who's affected by it, and when do I get involved. So I'll give you an example, and then I'm going to segue into what is going on out there in regards to what institutional money is doing right now, because I think this is super interesting time to see this. But if you look at home builders are the worst. Boo, home builders are awful. Meanwhile, what are they doing? They're going up. Why? Because we know where the puck's going, right? Skate to where the puck is going, not to where the puck is, okay? All right, so cool. So then we go here and just look at the simple moving averages. Nothing crazy, just simple moving averages. Well, why are they buying the home builders? Let's go take a look at regional banks. And I think this is very interesting. Regionals are rolling over. Okay, so it's not just the rates, right? Because why would regionals roll over? No, it's the home builders. And that this is so depressed over these valuations. See, what will happen when you go through any kind of cyclical or sideways action in the market? Meaning, if the market, just bear with me as I say this, don't get nuts, but if the market goes sideways to down, what happens to people? What do? They start to do what? They start to buy homes, right? That's what they do. They take the money out and go, you know what? I always wanted a McMansion with a nice gazebo in the back. I think I'm going to start doing that. And so you'll have these periods of time where the market will kind of trade sideways for years. You'll come back over levels. And that's really what started this whole boom, that and cheap money and gazebos. And then obviously, the cycle of, we'll leave it at that, was complete. And during this time, if you go and take a look back here, I don't even have to go that far back. Here we go. So here we are, 2010, 11, 12. Look at home builders outperforming the stocks. Now, does it always do this? God, no. But there are periods in time when you're going to go through these areas where they're going to cut rates. And so when I look at something like this, what I think is really important about these relative performances is exactly what we just talked about. If we go and find those trough valuations on relative performance levels, what do you see here? All right, so if you were to look at this over 5 years, if you bought the home builders here versus buying semis historically over 5 years, how'd you do? You killed it. You absolutely slaughtered it. So what this boils down to, again, is I love when people tell me I'm rambling. It just lets me know that you're not following along. But what we're getting here is you're getting an opportunity for the past 5 years, if you're buying home builders versus selling the stocks, right? As a pair trade, what are you getting? You're getting outperformance. This is exactly where you step into the market and buy home builders and short the stocks. Now, does that mean that you have to do the pair trade? No, it doesn't, because you could still say you don't know what you're talking about, Boomer. AI is going to the moon. And I would agree. I think AI is completely undervalued still, and I still don't think people are getting it. The purpose of understanding this is for you to be able to go through this, and you can do what I just did over the past 20 minutes with every sector and actually look at it from a what, who, when perspective, and it will show you the pockets that you should be looking at. Let's get to it. What are institutions doing? So we have smart money, dumb money for those that are new. We do not refer to this as smart and dumb. We refer to this as institutions. Retail. Why? Because smart is not always smart. Institutions are not always smart. Retail is not always dumb. Retail does move very fast, and smart, i.e. institutions, do move very slow. And I think that that's very important to get. When I see convergences, we want to pay attention to them. And we have one here we want to pay attention to. So the very first thing that we're going to take from this graph is that when smart money gets to this bottom level down here, that is usually an area where they are saying, okay, things are pretty overvalued, and we just don't really want to own. And then they get to a point where they'll start buying. Usually the best point for them to start buying is something like this, and you can see in the market as a whole, that's when retail is like froth and they can't own enough of it, and everyone's out there, buying an NFT or whatever, right? Everyone's like all giddy with themselves and how smart they are. And then the market comes down, and then retail will puke, and then what happens from when retail pukes? Institutions will then sell. And this is why it's super important to understand that institutions and retail are not always wrong. They're not always right either. It's more of I would refer to it as just like a balance. So for example, just because retail was wrong here and institutions were right to be out of the market and then bought, well, institutions didn't do very well on this buy. As a matter of fact, institutions sold into this and retail bought, and retail did exceptionally well. And then institutions had to catch up. Why is that important? So you understand the nuances of the graph. Once you get that, you can kind of go forward with what we're about to do. So what are we about to do? We're going to talk about what I think are the most important areas of the graph, which are convergences, and then to watch those convergences. For example, retail moves fast, institutions move slow. Institutions are dumping, they're filled here, and they're selling on the way up. Retail continues to buy in that area the entire time, bailing out institutions of their positions. Institutions are dumping from here to here, and you would say that they did exceptionally well over that period of time. So we could see that, right? I mean, that just makes perfect sense if you really think about it. Like, oh, they bought at the bottom, and then they're just dumping the whole way up. All right, cool, that makes sense. What about the difference here with where we're hanging out? What do you mean? Well, we're hanging out up here. We're retail, and we're hanging out up here, and we're just buying, and institutions are buying as well. So when we look at these crosses, as I'm about to show you, there are discrepancies with them, meaning if retail does not panic and retail holds what it has, then institutions have to buy, and they have to buy into less supply than they would have as if retail panicked. That's the difference. And you're seeing a little bit of that discrepancy in here now. And I'll give you a great example of this. It's actually on this graph. So if you look right here, you'll see that this is where retail crossed institutions. Retail moves fast, so they're going to buy everything. Institutions move slow, so they're going to take their time. So from that point on, if we were just to come here and mark that off, we can see that level right there. That was a great spot to buy. If we look here and we see that convergence where retail's got to get out, they got to get out now, the sky is falling, and institutions are like, yeah, we're going to buy, but we're going to take our time. But retail sells fast. And you look at that level right there. Well, that was a great spot for us to short the market, right? And that's when we got all that liberation. So what is this telling us? Well, it's telling us that we want to watch these points of convergence, but it's also telling us at the same time that we have to be cognizant of these convergences because maybe we'll have a slight pullback with them, but we really need to see retail get out of the position. So if we take a look at this area in here, and really what I'm going to focus on is just, because there's a couple of really interesting spots here, I think there are, but if we take a look at this spot right here, and we can see institutions saying, yep, I want to buy, and retail wants to panic. And this is May 2002. And you go, all right, well, let's just mark that sucker off. Yep, there it is. And you can just see that was perfect timing to get out of the market. And then if we kind of take a look at some of these other areas, you'll see these little blips where the same thing is happening, and it was a great time to get out of the market. But if you see like this one here as well, let's just do it again. Was that a great time to get out of the market? It was. Where was the time to get in really to the market? When retail flips back over. So what we need to understand is we need to see retail hold. And if retail holds, you're fine. If retail stays in here, you're okay. If retail starts to panic, retail starts to get out, you have an issue. The problem is that you could stay up here for a very long period of time. We just have to keep and monitor this. 2018 had some great examples of where I'm going with this. So if we take a look down in these levels and we see these points of convergence, right? And you can see the flip and then the other flip right in here where retail takes over versus where institutions take over. Like, where do you want to buy? Where do you really want to get involved? You'd want to get involved here. And you'll see it over and over again. You really can't miss them. So I think it's super important to get that. And then here you have October 18th, which was obviously when we first, whether you're there or you're here, it doesn't really matter. And you'll see them, and they're not perfect, guys. Like, it's not going to be all the time. I mean, if you look at this one, that really marked the bottom of that area in January 18. But they are there, and they're significant. I would argue that I do think that retail rushing in is always better to see that flip than the next, because it's just easier to spot because retail moves so fast, where institutions are going to move much slower. And what it's going to depend on is how much does retail really panic. As for growth drivers, what do we really see? And again, what, who, when? I can't stress this enough. Earnings come out on Apple. And I tell people all the time, you need to listen to these conference calls if you have the time. We listen to them in the communities. I'll type out notes on them. I was really surprised that this dropped that night on earnings. It really didn't make any sense to me. It was a really good call. He explained that this was actually coming. He's like, hey, in the next couple of weeks, we have a lot of announcements that are coming out. He walked through the entire AI theme, what he was going to do on the call. So it was really surprising to me that it dropped, but it presented an opportunity for us to get involved in it. All we had to do was just kind of wait it out and then find our spot. And here, I'll show you down here. So you can see, so these are like alerts that I put out, obviously not like alerts, they're alerts I put out to get into Apple where our stop was. And I also bought calls on it, the 205s, which I closed yesterday. I think they were up like 200 and something %. And then I also sold puts around $8 to pay for the calls, so I didn't have to pay for them myself. It just made sense because they were just going to deteriorate as long as I didn't break that 199. So they were worthless. So he took in another $8 to pay for the trade. And now, of course, we still have the stock. So obviously the trade's working out, but what's really important is what's going on here, because this is going to be the driver. And I've seen these kinds of cycles before, and they start to pick up other stocks in the whirlwind. And I'll show you what I mean by that. So we look at a couple of these notes here, but we look at something with what's going on with Corning. Obviously, you have a great, powerful move coming out of that. But also the news that Apple is going to start putting more and more money into the U.S. and into U.S. companies. That's why Corning moved. If you took a look at Texas Instruments, even though earnings had it fall off a cliff, you had some really good news on Apple and how they're going to start using Texas Instruments. If you combine all these news articles that are out there and what Tim Cook is saying, I think that this stock's going to have a resurgence. I don't think people are fully getting where this is going to go yet. I'm going to tell you where my head is with it. Apple climbed 5%. White House officials confirmed iPhone maker boost investment domestically. $100 billion brings its total to $600 billion over the next 4 years. Apple Trump detailed $100 billion spend expansion iPhone glass factory. That is Corning GLW. The company said its investment would incentivize overseas companies to buy more U.S. made parts. The commitment is on top of a $500 billion announcement. So the goal here is not only to drive U.S. investment, but to get overseas companies to buy more used parts. That makes sense. And then, of course, Tim Cook goes to the White House and brings some poster boards. And then we can see him standing here behind or in front of those poster boards. Apple said it would collaborate with Texas Instruments to install additional factories in Utah and Texas. Global Foundries, a US-based foundry, a lot of people don't even know this company exists, particularly for the US government, will manufacture wireless charging technology in New York for Apple. The iPhone maker said its goal was to have end-to-end supply chain, which means every part of the chip-making process can take place in American soil. Earlier this year, Apple said it would invest $500 million in a rare earth miner, and it would build AI servers at a factory in Texas. This is the part that I think people are missing out on. It would build AI servers at a factory in Texas. Now, this is Global Foundries, and we can all see the pop up on the news and then the great selling on the news. This is kind of a dark horse to me because they don't really do the high-end chips. They do more of the chips that would go in a calculator kind of thing, the larger nanometer stuff. But they are a US-based foundry. Really who's going to benefit from this is going to be obviously Taiwan Semi. And I also think ASML benefits greatly from this. If you were to look at ASML, and it is very clear to me that this stuff leaked. And you can see it because ASML never broke the Apple conference call. So here's the Apple conference call where Tim Cook is mapping out everything. And if you go and take a look at ASML or KLAC and you look at these right there, I don't know why that says turquoise, but if you take a look at these right in here, that's the bar. They all held Lam Research, all of them held on that bar. So it's very clear to me that this leaked and that you never broke those levels, ever. You broke those Friday levels. And they all coincide perfectly with that 55-day moving average, all of them. So you're obviously seeing them understanding that this is going to ramp up. Remember, this goes back to what, who, when. I'm not saying you're not going to have bumps in the roads. I'm not saying that there's not froth in the market. We've gone through that ad nauseum. But there are pockets of strength that are coming here that people are not fully grasping yet, and they're going to. And I think that if you can have something like an Apple turn, and you really get what's going on here, it explains the movement. Now, there were some great trades that you could have had on Friday on the name, and there's been some amazing trades that you could have out there on some of these names on earnings. But really what you're looking for is you're looking for that name that people have completely just thrown away. Like, oh, Apple's dead. No one needs a new phone. I don't think people are connecting the dots yet that Apple doesn't even have a cloud business. Now, if you're going to start building data centers in the US, doesn't it make sense to start a cloud business? And then you would think about that and going, well, that was Amazon's key grower, right? Amazon's key grower is what? It's not you buying trinkets. It's AWS. That's their key grower. What's Microsoft's key grower? Azure. Right. So is Microsoft and Amazon not rallying the same way? And we go take a look at Google, actually had a decent day, broke out. But are Amazon and Microsoft not rallying the same day? And then we kind of take a look at when this started to fall off and go, why wouldn't Microsoft rally? Their key business is just rocking. Right? And we're like, oh, it's too expensive. Okay. Do people think, and I do think this, I think that Apple starts a cloud business to compete with AWS and Google. And I think that's going to kill margins on all of them. And I don't think any of that's factored in Apple. And that was one of the key things that I took away from that call. If you ever have the time to listen to these conference calls, I would strongly suggest that you do it. Another really big area that I see a lot of issues with is this group think. The fact that someone issues a short report, therefore they must be right. And then you see these guys pile into the shorts and then they get destroyed. A lot of these guys that issue short reports, they could be right. They have been right in the past. You just have to think about what their actual motives are on coming out and issuing these short reports. Once you understand that, it makes your life a little bit easier. If you take a look at something like APP, and I want to be real clear about this, there are certain names that these guys have gotten 100% right. Like SMCI, they absolutely nailed, right? I mean, there are names that they've gotten right, but they are getting destroyed. So when you see something like an APP or an RBLX, where these guys were telling you to short it at 50 because it's a disaster, or short APP because it's going to be a dumpster fire, and then the short CVNA because it's definitely going to fall apart. And now all of these names are up 100 or 200% from those levels. So these guys are getting killed. So when you're going into earnings like this and they're wrong, there's nothing more for them to do. There's if their thesis doesn't play out on a fundamental basis, they're just going to get squeezed and destroyed. When you understand that level of group think, you have to ask yourself what that catalyst is. So one of the things that I try to teach you, one of the things that I want people to kind of get is if you understand the methodology, like how somebody really thinks. So picture somebody that's short here that's following along and the earnings come out and this is the move that you get. And you get that one move down and then you read the report and that guidance is fairly good and the earnings are good and everyone on the conference calls saying how great the company is. And then you go into your morning and you're just watching it tighten and tighten. And you can see right in here at 9:30, All you have to do is not even use those levels. All you really needed to do for this, to understand how they're going to think, is just watch that close. So if you just go here and you just literally watch the previous close, that's the people that held. Once those people get shaken out, that's it. Like, there's nothing left here for them. The trade didn't work. It's not going to work. They're getting destroyed. And now you're back to the close. And as soon as you got back to the close, and that is the single most important area that you can watch on any earnings event. Just remember that this week. The single most important event that you can watch on any earnings is going to be, it always is, the previous close. Do the people that made a decision to hold into earnings, do they still want to own it? Forget the open people. You do want to pay attention to those crazy cats, but you definitely want to pay attention to the people that said, no, I'm going to stay longer. I'm going to stay short into the close. I'm right. When it gets to that level and flips back, they have their come to Jesus moment. And then you can see it from here. Just doji flips, sideways, breaks out, and then the rest is history. And it presents a huge opportunity for you to exploit that and take advantage of it. But this was something that we caught, and we're actually able to make 40 points off of this. And when we did the trade, I didn't think we'd make anything like that. But now this thing's turning into a massive swing trade. Here, watch this play out live. I'm going to buy APP here. Let me see what they do. I might be kicking it real quick if it doesn't get moving. I'm up 2, trimmed, up 3. I don't think you're going to break, but let's just give you a minute here to see if you're actually going to take out the low. APP, you're still breaking down, so just let it break. But I do think you're going to turn at some point today and present an opportunity. I do think it's coming. Hourly is going to look a lot different to people. If it closes like that, there it goes. Oh, you're finally over. I think they're just going to squeeze the living bejesus out of them all day. It was probably like the last ditch effort here and see what they could grab from them. See all the people short that area, and they just closed right over. Now that's pretty much a wrap. Get a close like that, you can actually have a swing trade off of it. This is your next level, 428.99. I think you'll get there. I think you're going to get back to that 429 today. What I'm going to do is I'm going to watch how hard do you bounce off this level. If you bounce hard, I'm just going to kick it. If you bounce soft, then I'm going to give it a shot. I think you're going to go right through it the way this thing's acting. If it does go right through it, then there's nothing for me to do. It doesn't look like you're done. See how the wicks are to the downside? What I will do is I think you should move the stop up to like 425 on it. 470? Am I getting greedy? We know it's short covering. We know it's not a desire that you have to own the name. So we might be getting there, guys. Party's over, huh? Okay, party's over, guys. 444. My point on showing this today, because people always ask me, like, where are you going with all this? You have massive discrepancies in this market between what people think is going to happen and what is actually happening. And it presents huge opportunity. From my perspective, it's presenting the opportunity more on stock selection than index selection. So in other words, is the market going to go up or is the market going to go down? For me right now, in looking at this, we fell apart hard. And you did something that you don't normally do, which is break your key levels in here. So I tend to look at that stuff and go, all right, I need to pay attention. And before, I dive into that in a little bit of detail here, I think it's very important to look at this and say, yeah, I did something I didn't normally do. And when that does, from years of doing this and get my teeth kicked in, when you do something you don't normally do, like break the 22 and close below it, I just put the brakes on because I'll preserve capital because there's always opportunity to buy. There's not always opportunity to protect your capital. Like, you have to understand the difference. You can always buy a stock back, right? And that's why it's called risk on. You can't always de-risk at the same price points, but you can always get back in and make money. You might not get the same price, but if you're right, you can just still make money. You can't always protect capital the same way. It just doesn't work that way, right? Whether you sold here or sold here, and what you don't want to do is sell into a panic. So you always want to be, I always view it as being cat in a hot tin roof, like be merciless with your stops and be very aggressive with your buys because you can always just, I'm out. And if people that watch me live trade all the day see it, like, yeah, I'm out, I'll come back to it. And it's super important to get that concept. So when I see something like that, the brakes go on. What we have to do is say, okay, what if we went sideways for a while, which can happen. The market can go sideways for a little bit and work some things off. Let's clean all this off for a second. And what's that going to do for us? Well, we're just hitting new highs. Well, do we have a reason to be at new highs? I would argue that there's more reason for stock selection than there's ever been. That's where I'm going with this. I think understanding why you should be looking at like the home builders right now, why you should try to understand why the stocks keeps moving, why you're watching names like AVGO continue to hit highs. And we've been talking about getting in this name, or we've been in this name now since 180 on this last swing trade, and it's never given me a reason to get out of it. I think we're up 120 points from the last swing alert. But like when you get these concepts, It makes sense. It's the same thing when you understand with like coin, when people will say to me, well, why are you short coin right now? And you understand what happened on that call. It would make sense to short it, realize that for them to make money, it's going to take a very long period of time on the stablecoin side. So understanding those nuances are going to get you where you need to be. But you can do the work yourself. You don't need somebody to tell you to do the work. It's simple. You follow them, you listen to the conference calls, and you listen to what these people actually have to say. And you can do this yourself. That's where I'm going with this. I don't know if you're going to see, block and crypto keep lifting the way that it is. I'm not so sure on that. I do think that if you look at the underlying hood, that the underlying assets are setting up. Like this stuff is setting up. And I'll take this all off for a second, but this was something I set up and I sent out to the community like probably about, months ago. But what you're seeing here is this enormous cup and handle, and you're breaking out of it and you retest the low end of the handle, and that coincides perfectly with that 55. Like that's holding. That this is unequivocal. It's holding. If you go back and take a look at Ethereum and you see this breaking out the way that it is, I almost feel like because I got it here with why it was doing what it was doing, I almost feel like this is just an absolute no-brainer for people to look at and go, why aren't you getting involved with this? Right? Especially if you're going to have all these, quote, treasuries go out there and just gobble it up. I mean, they're getting free money, right? So why would you, this is what always fascinates me about things. Like, if BMNR is willing to sell their stock for, they're exchanging their stock for Ethereum, right? They're exchanging their stock for Ethereum. Why are you exchanging your cash for BMNR? It doesn't make any sense whatsoever. Why wouldn't you just do what they're doing? Because they are saying that their stock value has less value than Ethereum. So why wouldn't you just do the same?